The gold market is going to need another paradigm shift if it is going to see another rise similar to last week, which pushed prices to a one-year high. Joining us in studio today is Erik Norland of CME Group. Erik, good to have you back on the program.
Thank you for having me.
So you just wrote a report that's really timely, entitled, Gold Rally, is it a flash in the pan or sustainable? And that's what I'd like to talk to you a little bit about today. And you mentioned how this global market meltdown has been really beneficial to gold. Yet, Erik, you don't think that gold prices have a lot of room to move here?
Well, I think the problem is this. So you're right, gold has rebounded a tremendous amount. On the day that the Federal Reserve hiked rates back in December, it was trading around $1,050 an ounce. And then we saw nearly a $200 rally in gold, including a few really spectacular days when it gained as much as $60 in one day. But what really drove that, though, was a change in expectations for what the Federal Reserve will do. So at the time they hiked rates on December 16th, the Fed funds futures market was pricing that they would do 2 more rate hikes this year and an additional 2 rate hikes next year. And since then, the market has dramatically changed its expectations. Now it's pricing no rate hike this year, probably, and maybe a rate hike next year. And that's great news for gold, right? Because gold pays no interest. So the fewer Fed rate hikes we have, the better the news for gold. But the problem is that move in interest rate expectations is probably mostly behind us. And I don't think the Fed funds futures has much in the way of further expectations to deprice.
Okay, so you think it's already been baked into the price.
Right.
So is this why we wouldn't be able to see another 2011 scenario for gold? Is it still possible?
Well, it is possible. You have to remember that back in 2011, we not only had 0 rates, but we had the expectations they would stay at 0 for a long time, which of course they did. And we were also in the midst of a series of quantitative easing programs. Now, QE is over. The Fed has now begun to tighten policy. So gold is just in a very, very different place with respect to monetary policy now than it was back in 2011. And also 2011, you have to remember that the gold mining supply at that time on the supply side of gold was just starting to rise from its 2009 low. But between 98 and 09, gold mining production had been declining for 11 years in a row. So the gold market, at that time in terms of supply wasn't that generous, but now gold supplies have risen quite a lot.
Okay, and on that note, you had something really interesting in your report. You said, look, if gold prices go higher, that might not be beneficial to all.
That's right. So the gold price rise has been wonderful for people who own gold in the past few months. But the problem is looking forward, it now makes gold mining more profitable. Gold mining probably costs about $1,000 or maybe slightly less per ounce of gold. And now that the price is around $1,200, that gives the miners probably more than a 20% profit margin. So it reduces the incentive to cut back on production.
Finally, Erik, let me ask you, what about the relationship between gold and crude oil? In the past, they've traded in tandem, but right now we've seen such a divergence. What do you make of it?
So gold and oil traditionally have a ratio of about 16 barrels of oil for 1 ounce of gold. But last month, they actually went up to a record high. So gold was buying as many as 46 barrels of oil for 1 ounce of gold, which is really an extraordinary ratio. Now, the decline in oil prices, of course, has spooked equity investors, which caused, in part, the depricing of the Fed rate hikes. So in the short term, lower oil prices have been good for gold. But longer term, it's not clear that it's really a good thing.
All right, Erik, always good thoughts from you. Thanks so much for stopping by.
Thank you for having me.
And thanks for watching this edition of Kitco's Gold Report. We'll see you tomorrow.